Hey everyone. Okay, a few things to talk about. So yesterday I talked. It was a red day yesterday, and usually on red days, if I say something positive, I'm just a shill for my stocks or whatever. Freaking haters. But anyway, one of the recurring comments on my video yesterday was that, well, Kevin, of course spending is up because if inflation is up, things are more expensive, and therefore spending is up. So we got to break this apart and talk about that. We got to talk about a huge catalyst that actually happened yesterday, and it kind of a lot of us I don't think realized it, and it might be a reason as to why the market's green at the same time as those 10 years are rising again. So let's talk about this first. We need to break apart this thesis that absolutely consumers are spending more solely because prices are up. So, an easy way to look at this, in my opinion, is this. Let's say you have $1,000 a month for consumer essentials and discretionaries. Maybe, I don't know, outside of your rent, $500 of that are for essentials for yourself, and $500 are for discretionaries, right? Let's just say. So now you have $500 to spend on discretionaries, which could be restaurants, junk from Etsy, new shoes. I don't know. You save a couple months and buy an inexpensive computer or whatever, right? Okay, so what happens when there's inflation? Well, when there's inflation, you might still have. You probably still have. I mean, inflation doesn't take away your dollars, it just makes them worth less, right? You still have that $1,000 to spend. However, you're getting less stuff. So maybe instead of saving for 2 months for a computer, you have to save 3 months, which now means a month went by that you weren't able to buy new Nike shoes or something else. See, when inflation happens, it's not so much a matter of you spending more money, it's more of a matter of you getting less. Now, this is different for essentials, right? If you go to a grocery store, yeah, you're going to have to spend more money on essentials. But when consumer spending is going up for non essentials, it's a sign that consumers are optimistic. It's a sign that consumers are saying, no, you know what? We're not worried about inflation being so entrenched that we think inflation's going to go up forever. And we're back to the 70s and early 80s where we left the gold standard and, oh my gosh, the dollar was going to become completely worthless. We're going to have monetary regime change, like the Ray Dalio or whatever vision. I don't think it's going to happen, at least not anytime soon. And by soon, I mean like the next decades. That's a cool car. Yeah. So anyway, this is a very important thing to consider when you are an investor looking at inflation data and you're looking at, okay, what's the consumer doing? Oh, they're spending more. Now, sure, partly there could be this rationalization that, okay, yeah, I mean, maybe it's a mix of both, right? I ran a poll on Twitter, and a lot of you thought, okay, well, it's probably a mix of both. But if you read the comments yesterday, it seemed like people were unanimously under the impression that consumer spending was only up, that banks were reporting consumers are spending more, and that banks are reporting that consumers actually have more money or are expected to have more money in their bank accounts this year because inflation's up. It doesn't work that way. It doesn't work that way. That's wrong. It does not work that way. So this is actually very, very positive. That when we break it apart and we think about inflation, we think about, okay, people maybe are spending more to either continue this lifestyle of consuming, and they're purposefully finding more money to spend more to continue getting the same amount of goods. Yeah, sure, inflation could drive the need, but they are willing to do that, and they are consciously willing to spend more on non-essentials, which is a great sign for trying to prevent a recession. Now, I do think that internationally, we're going to have some major issues with GDP. In the course member live stream this morning, we were talking about police helicopter. Ooh. In the course member live stream this morning, we were talking about global GDP and the IMF's reductions for GDP forecasts. And look, it's all a disaster. It's all a problem. Globally, we're going to have massive issues. But I also posted on Twitter, don't bet against America. And I believe that. I really believe you do not want to bet against America in this sort of economy. And so what is that catalyst that happened yesterday that a lot of us kind of forgot about? Yeah. So, by the way, my office is a disaster right now because I kind of tore it apart. I got bored of my set, so I'm making it new. And I've also got bored of streaming on a Mac because my Mac sucks. And then I sold all my Apple stock. Okay, well, that's a different topic. But anyway, so the catalyst that happened yesterday was tax day. a lot of people made a lot of money in 2021. Oh, did I mention? No, I didn't mention it yet. Oh, the slide's wet. This sucks. Anyway, if you want to know more about this wet slide, keep in mind that there is a coupon code for the amazing programs on building your wealth that expires tomorrow, Tesla earnings day. You can join me in those course member lives where I spend usually about 45 minutes to an hour every day answering your questions about what to do in your situation, maybe, hashtag not financial advice, real estate market, explaining deeper theses. It's kind of fun. I think you'll really enjoy it. Plus, the lectures are absolutely amazing. People say they're better than college, so thank you to those of you who say that. That's an honor. So what was the catalyst? Well, tax day. Okay, so why does that matter? Well, a lot of big money made a lot of money in 2021 because people were able to potentially take gains from 2020 investments. In 2021, the real estate market killed it. A lot of people made a lot of money in 2021 and 2020. Not only because of stimulus, but also because of investments. They were great, 2 great years, 2 phenomenal years. 2020 was better than 2021, but still 2 phenomenal years. And so I just paid lots of money in taxes, close to $10 million in taxes, and we might end up having to pay even a little bit more once we finalize everything. Kind of crazy, but I'll post those on Twitter probably later today, so that way you could see the receipts, screenshots, or it didn't happen, right? Can't really do that right now. But anyway, it's no surprise to me that yesterday was a red day, and then today is green because, all right, tax day's over. This is wonderful. This is phenomenal. So what do we have going forward, though, this week? Well, we've got some really important earnings. We've got Netflix is going to set the stage here. We've got a bunch of consumer staples reporting this week as well. We had Johnson & Johnson this morning. They actually lowered guidance a little bit, but a lot of them has to do with the vaccine. And I'm starting to read their earnings call. Nothing super exciting that I'm seeing about the consumer and the J&J, but we'll see from some of the other consumer staples reporting. Netflix is obviously going to be big, especially for Disney. After that miss in Q1, I wouldn't be surprised if we get some nice beats. And that's what I'm hoping for, because we had ugly earnings results for Netflix that really set off a horrible Q1, well, it's Q4 reported in Q1 earnings season. Now we're in Q2 reporting Q1, and I'm quite optimistic. Now, I don't want to sound like, permabull. I still recommend stay out of margin. If you're in margin, you better have a piggy bank to get out of it right away. Like, for example, I tiptoed slightly into margin, but that's only because I'm waiting for some real estate transactions to close, and then I'm getting out of that again, which is totally fine. That's money that I expect to come, and it's not that big of a deal. But I would not be going into margin to buy stocks. Although, I mean, if you were going to make bets on the market, I'd rather make bets on the market at, and people make fun of me for this too, the QQQ Fibonacci at bouncing off at 23.6. Hey, we get some nice call options on QQQ, so maybe I'm a little biased, but we'll see. Hopefully we get not only a good confirmed bounce today, but that we have a really green week this week, and we get some great earnings reports. So we'll see. I'll be covering Netflix later today. Do keep in mind, as this 10-year rises, the housing market is going to come under pressure, and that could affect consumer spend, though, but that's going to take a while. It could take probably 9 months to 12 months for consumers to actually react to housing values potentially going down, even slightly, right? So that's not sort of a larger near-term catalyst. Bigger catalysts right now are obviously Ukraine and the disaster in the Donbass, which we expected that this is all coming prior to Victory Day, May 9th. That's a big catalyst to get the FOMC meeting on the 4th. CPI and jobs data before and after these dates are kind of intertwined in the first couple weeks of May. So you've got a lot of catalysts coming up, but This next couple weeks earnings season here, in my opinion, is going to tell us, are we going to be able to get through all those catalysts without a hitch? I suspect the answer is yes. No guarantees, of course, but if we get really strong earnings here, we're going to plow right through whether the Fed raises 50 or not. And remember, this is another big thing too. In other words, we're going to plow through optimistically. One of the things that everybody forgets about the Fed is the Fed doesn't want to use their tools. They have to, and they will raise rates, but they don't want to have to use their tools to affect the economy. They want to just be able to talk, because if they can send Bullard out and freak out the market a little bit, and some of these hawks out, and rates go up, and the economy tightens and demand wanes a little bit, they're actually accomplishing their mission without doing anything. And that is a surefire way to win for the Fed, and they realize how powerful they are now with just their words. So pretty excited about that. In other words, that because we've seen so much tightening over the last few weeks, and red really coming out of the end of March, which we expected. I thought we were going to run maybe another 5% on the fib. We didn't get fully to that 2/3 on QQQ. We got to about 60%, but hopefully now we get a nice rebound off of this, and most of the tightening's already been priced in, and the Fed talks to us at the beginning of May about exactly how, hey, market's already tightened quite a bit. We're happy with this. We're starting to see core CPI go down, whatever, PCE numbers settling down. That's their favored inflation measure. Anywho, these are just some thoughts on the morning. Good luck out there. I hope you make some money. And thanks for watching. Check out those programs on Building Your Wealth. Remember, every single one of them comes with a course member live streams. And if I had to pick one right now, I'd probably go Zero to Millionaire Real Estate Investing. Because if you're watching this, there's a good chance, I would say probably, I don't know, maybe leave a comment down below. But my guess is maybe 60% of you don't own real estate. You should all be in Zero to Millionaire Real Estate. Like, take 12 years of knowledge in the real estate market, going through crazy markets and up markets and down markets, and and apply that to building your wealth. You'll love it. All right, folks. We'll see you. Bye.